You know, when you make a Roth IRA contribution, it doesn't help you on your taxes today. It's an after-tax contribution. It's down the road where you see the tax benefits. So, could you actually get a tax credit today for making a contribution to a Roth IRA? Not everyone qualifies, but if you do, you want to take advantage of it. I'll explain that more coming up. I love the Roth IRA. I hope you do as well. It's not one size fits all. It's not for everyone in all situations, but it's for a lot of people in a lot of situations. More people should be using it than actually are. The Roth IRA, and by the way, Roth 401k as well, when you make a contribution, it doesn't help you on your taxes today. And I'm going to put an asterisk right next to that comment. But just assume that's the case. It's after tax that you're making the contribution into the Roth, okay? It's not a deduction. That money goes in after tax. All of the capital gains, the dividends, the interest, all the growth on it is tax sheltered or tax deferred. So you're not paying, it's not landing on your tax return every single year. But then if you've had a Roth IRA, any Roth IRA for at least 5 years, that's the original, the OG 5-year rule, and you're age 59 and a half, then all of that growth you can withdraw in retirement tax-free. So if you're young or in lots of circumstances where it's going to make sense to fund the Roth IRA, yeah, just lots of huge tax savings, but they're out there in the future. Is it possible that you can get a tax benefit today for funding your Roth IRA? Yes. Yes, you could. Not everyone qualifies, okay? The qualifications are, it's stingy, okay? But if you do qualify, you have to capture it. You have to optimize and take full advantage of it. What I'm talking about is my favorite tax credit out there. I've done a lot of videos on it because it often flies under the radar, and a lot of people who otherwise could really take advantage of it, they miss it. And I don't want that to happen to you. So here's how the Retirement Savers Credit works. And it's not just for the Roth IRA, but yeah, you can use it with the Roth and it works fantastic. If your income, adjusted gross income, is below certain thresholds, then you can get an additional tax benefit for making a retirement contribution. You can get a tax credit, okay? A tax credit on the first $2,000 that you contribute to a qualifying retirement account. A 401k, a Roth 401k, an IRA, a Roth IRA. Yep, they all count for that contribution. And if your income, adjusted gross income, is below certain levels and you're still contributing to retirement, then you can get a tax credit. How much tax credit? Well, the first threshold is 10%, okay? So 10% on $2,000, that's $200 and a tax credit that you'll never have to pay back. It's cash money. It's just an addition to your refund, okay? And so that's 10%. The next threshold, if you qualify, is 20%. So $400 on a $2,000 retirement contribution. And yeah, even some people, we've helped people achieve this before, get a 50% tax credit on the first $2,000, $1,000 tax credit on a $2,000 retirement contribution. Here are the numbers, okay? The qualifications, like I said, it's pretty stingy. So for 2025, if you're listening to this in tax season, you can still fund your Roth IRA for last year. 2025, married filing jointly, you are eligible for this tax credit, the Retirement Savers Contribution Credit, if your adjusted gross income is below $79,000. If it's below $79,000, then you can qualify. Well, that first threshold between $79,000 and $51,000, that's the 10% tax credit. From $47,500 to $51,000, so a very small window, gets 20% tax credit. And then $47,500 and below, that's where you can get the most, the maximum, the 50% tax credit. That's married filing jointly. You can see here for head of household, and then single filers, you only qualify for this if your adjusted gross income is below $39,500. You can get the 10% credit if you're between $25,500 and that $39,500. Again, a very small window for the 20% tax credit, and then the 50% tax credit if your income's below $23,750. That's for 2025. For 2026, those numbers expand just a little bit. You can see here that the married filing jointly, you're eligible for this tax credit if your adjusted gross income is below $80,500. Single filers, you're eligible if it's half that, $40,250. So here's why I bring up that you can get a tax credit for making a Roth contribution. One, because often you don't get any tax benefit today for making a Roth contribution. So the fact that you could qualify for this tax credit, even for doing a Roth, that's a big deal. But then second is if you are in these income thresholds, right, it's likely that you're in a low tax bracket. Right? If your income's below these adjusted gross income levels, then likely it's going to make sense for you to willingly pay the tax today so that you can avoid all the tax on the growth out there in the future. And that sets up perfectly for the Roth. But a lot of times and we see this a lot, we do nearly 3,000 tax returns a year. We see this a lot where people miss this opportunity. They miss out on getting the maximum retirement savers tax credit for two reasons. One, oftentimes when it's available, it just pops up out of thin air. You're not looking for it, you're not aware of it, it's not on your mind, and then all of a sudden the circumstances are right where your income just uniquely falls below this level and you miss out. Okay, and I don't want that to happen to you. So these are times like right at the beginning of your career, you have no idea about tax planning, you're not really even sure how taxes work, and yet you're starting your first job, and therefore your income is, $25,000 as a single individual. You could qualify. You could qualify for a very serious tax credit. You just need to be aware. So if that's not you, but it could be your kids, be aware of that. It could be when you're moving from two incomes to one, either with a divorce, or maybe you're welcoming a child, or maybe you're unemployed, something like that. Yeah, when your work circumstances are changing, all of a sudden, and financially those are challenging times, but all of a sudden you become available for this tax credit, and I want you to take advantage of it. And then right at the end of your career, depending on when you retire and what your income sources are when you do, yeah, that could mean your income is all of a sudden very low and you could qualify for this. So that's the first reason why I'm really pointing this out. I want you to maximize it. Is it tends to come up out of the blue. You're not aware of it. It's not top of mind, and all of a sudden it's available. I don't want you to miss out. And then the other reason I'm punctuating this is a lot of people, when they do take advantage of it or when they do receive this tax credit, they don't maximize it, okay? The tax credit is on the first $2,000 that you contribute to retirement. Oftentimes, if you're at the beginning of your career, maybe at the end of your career, maybe you've had some interruptions to your income and all of a sudden you qualify for this, you've only been contributing just a minimum amount to retirement. You're, maybe only contributing just a little bit, and yeah, you've contributed $1,000 and you get this tax credit. Okay, big deal. Well, maximize it, right? The credit is on the first $2,000. We also see where people that are filing a joint return, married filing jointly, miss out on maximizing this credit. Typically, if your income's below these thresholds and you're married filing jointly, it's because it's a single family household. One individual's working, the other individual's maybe staying home taking care of the kids, and that often means just one person's contributing to retirement. We see it all the time where that individual is making, maybe $75,000 and they're contributing 10% to retirement. So $7,500 is going into retirement, but that's $7,500 for that one individual. The retirement savers tax credit caps out on $2,000 for that individual. But if the other person did $2,000, then they'd get double the tax credit. So instead of having the one individual that's working outside the home contributing $7,500 to retirement, what if they contributed $5,500 to retirement and the other spouse contributed $2,000? You still have the same cash flow going into retirement, $7,500, but you've doubled your tax credit. So I want you to be aware of this opportunity so that you can spot it, take full advantage of it. And then, I want you to maximize it. I want you to take full advantage of it. Whether that's helpful to you, maybe to your kids, maybe to you later on down the road, take advantage of the retirement savers contribution credit. Yes, you can get a tax benefit today, a tax credit today for contributing to your Roth. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.